Hello, 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 everybody. Welcome back, dynamic business leaders. Today's focus is a crucial skill for every entrepreneur and business owner, understanding your financial statements. Think of these documents as a report card for your business. It's a business report card, giving you insights into financial health and performance. So before we get into this lovely topic, let me introduce myself. So my name is Shane Harris, and around here on these social media streets, I'm also referred to as Shane the Negotiator, and I help coaches, consultants, and service providers who are overwhelmed and lack guidance to achieve true financial freedom. And I do that by providing expert tax and coaching services. So today we're going to dig into Decipher Financial Statements, your business report card. So we're going to begin with the basics of financial statements. Financial statements consist of three reports. We have the balance sheet, the income statement, or profit and loss statement, which you guys are more familiar with, and the cash flow statement. Each serves a unique purpose in giving you a comprehensive view of your business's financial status. So we're going to begin with the balance sheet. The balance sheet is a snapshot of your company's financial position at a specific point in time. It lists your assets, liabilities, and owner's equity. Understanding this helps you evaluate your company's stability, liquidity, and overall financial health. Next is the income statement, which shows your company's profitability over a certain period. It outlines the revenue, expenses, and of course, the profit or the loss. This statement is important for understanding how well your business is generating income relative to its expenses, how much it's spending. Lastly, the cash flow statement. This shows the actual cash coming in and going out of your business. It highlights the company's ability to generate cash and reveals insights into operational efficiency, investments, and financial activities. So, I always have a little chart or something to show you guys. So, I'm going to open up my screen here and I'm going to pull up the chart to kind of go through each one of these to show you what they actually look like. So we're going to begin first with the income statement. So give me a second here to get to this income statement. Okay, here it is. And let me open it up so I can see it a little bit better. So again, this is not my company's or any of my clients' information. This is just a random company that I jacked off the internet that has this information out here, and I use their financial statements for this presentation. So this is not it doesn't tie to anything in particular. These are numbers that they generated. I don't know if this is their company numbers exactly, or if they just kind of put this together for samples. So I got this off of the internet. Okay. So in this particular one, so we're going to go through the income statement. So again, the income statement, it shows the profitability of a company when using the accrual method of accounting. And you were like, what the heck is the accrual method of accounting? The accrual accounting is accounting method in which payments and expenses are credited and debited when they are earned or incurred. Accrual accounting is different from cash-based accounting, where expenses are recorded when the payment is actually made and revenues are recorded when they actually receive the cash payments. So that is what accrual method means, and it's different from cash method of accounting. So we're going to look at the income statement here. So we're going to just fill in the years and see, make up some years. So I'm assuming this is going to be 2021, 2022, and they had projections for the subsequent years. So underneath historical, that's the actual years that this particular sample actually had business operations. So we're going to fill in and just say this is 2021 in the first column. The second column is 2022, and then they made projections. So this is like forecasting. They're going to show based on what the revenue and expenses were like in a given year. They're going to use projections to see what the future can potentially look like for a business. So this is very common, especially if you want to get loans, funding, if you want to get grants. These projections are very important if you want to get those types of things for your business. So we're not really going to go into projection. I just wanted to give you a quick overview of what they are because it's actually shown here on this chart. So underneath 2021, as we're going to assume that's what those numbers are, we have the revenue. So the revenue is 74,452,000. That's how much this company made in that year. So the next line, we have cost of goods sold. In other words, it's called COGS, COGS. This is generally when someone have inventory. So if you're e-commerce or you have one of those companies that have product or big machinery, then you're going to have COGS, or cost of goods sold. Next, we have gross profits. So let's go through these numbers. So we have 74,456 is the revenue. So the COGS, this is the inventory that they actually purchase. So inventory can be anything, any type of machinery that could have been purchased. It could have been vehicle, equipment, computers, software. It could have been all kinds of things that could have been purchased. It could have been actually they made purchases for the products that they're selling. So we don't know what this particular company, their COGS are, but it can be a combination of many different things underneath COGS for inventory. So they have 64,440. And this company's inventory, they have high inventory. This is 86.6% of the revenue they spent in inventory. So I know usually if I see a high inventory like that, it's usually one or two things is happening. I'm expecting to see a large revenue point because the more inventory you're going to purchase, if your inventory is moving and if you're selling inventory quickly, then your sales should reflect that. Or they're making purchases for equipment and machinery, and they're not actually reselling this. They're using this to make products for to sell, or they're using the machinery to operate their business. And of course, it's not turning a profit. So of course, that high inventory cost may not have anything to do with the revenue at all. So for this particular company, they have 86, almost 87% in inventory costs relative to their revenue. So that's high. That's a very high inventory. So the gross profits is $10,012. So they have 13.4% in profits relative to the inventory. So that revenue of 74,000, we'll round up and say 75,000. Inventory is almost 65,000, and they're netting what they have remaining after that is 10,000, which is 13% of their revenue. So you can see again that inventory is very high for this particular company. Then we have some operating expenses, percent of sales. So they have 63.89. So their operating expense cost is not very high. Because even if you look down to the next one, operating income, 3623, they're operating what they're spending in their business outside of inventory is not very high at all. So that's actually pretty good compared to how much the business actually made. For the expenses to be so low, that's actually not a bad thing at all. However, the inventory is very high. So let's go on down. We're not going to go through and read through all of these things because it's really not relevant. And I'm not going that deep and detailed into this explanation. I'm just giving you a general overview on how to read these and what they're for. So we have income tax expenses. They have 1,087. And then their net income is $2,018. So that's after the revenue that came in at almost 75,000, after you subtract the inventory costs, after you subtract the operating expenses, what they had remaining and all the other operational costs and taxes and everything, once it's subtracted, they have $2,018 remaining. So when you look at this balance sheet, and I'm not going to go into the depreciation and amortization and all of that stuff on this particular one, that's going to be another time. That's a little more detailed. I might do a masterclass to go into that for you guys if that's something that you want me to do. So we're going to stop at this net income. So when you look at this balance sheet and you look at this and you're like, not this balance sheet, I'm sorry, the income statement or your profit and loss, and you're like, okay, my company made a profit this year. It did. It's profitable, but $2,018, that's not very much of a good profit if you made 75K. So this particular business, although it's in the green, I wouldn't really say it's very successful because 75K and you only have 2,000 in profits is not the best. Now, if you're getting started and these are your numbers, then that's perfect. As you go on in your business, you want those numbers to continue to increase. So as you can see, if we go on to the next year in 2022, they have 83,000, and the net, if you go down to the net at 25,567, and they have projections over the next 5 years that end at 4,442 in net, and the projected revenue 134,465. And as they go on, because they're doing projections, their projection is at 10%. So everything is going to be at 10%. The inventory is still very high relative to how much revenue they have coming in. So let's go into the next one. So we're going to go to the balance sheet. That's going to be the next one we're going to talk about. So let's put the balance sheet up and go on in. So the balance sheet shows a company's assets, it shows their liabilities, and the shareholders' equity at a particular point in time. So let me open up my screen so I can see this a little bit better because it's tiny for me. Okay, so here's the balance sheet. So we have let's begin with the assets. So the assets is what you actually own, what you have. So it has, for this particular one, it has cash. That's the cash on hand. It has accounts receivable. Accounts receivable, that means invoices. So they have invoices that they paid, that was paid, and that's accounts receivable. Then inventory, of course, inventory, we've already talked about that. Machinery, equipment, it can be the products that you're selling. That's a part of inventory. It's an asset. If it's not sold yet, it's an asset. So it's 48,000 that they have for that. Accounts receivable was 7,750. Cash was 1,773. And then they have prepaid expenses here for 456. And prepaid expenses are expenses that use exactly what it sounds like. Prepaid, you pay for it before you actually have the expense. So this is 2023 we're in right now. So if I wanted to prepay for expenses for next year, I can do so. So I can make purchases for expenses that I'm not going to have until 2024 because I want them to count in this year. So that's what prepaid expenses are. And what they do not have on their particular balance sheet is their bank account. So in your particular books and in your balance sheet, you're likely going to have your bank accounts listed. So it might be one bank account, which it should be more. You might have 2, you might have 5, you might have 10 because you have multiple accounts, especially if you watch the last video that we did and we talked about profit first, the method of accounting. I went into that, and that video is going to be on this side somewhere. I'm getting my sides right. At the end of this video, it's going to be on this side. Now, it's not going to be at the end of this stream because this stream is live. However, after about an hour, then if you go back and you watch the replay, that is going to be on this side at the end of the video, where you can click on that to watch what we talked about the profit first method of accounting, and where we're going to talk about those multiple bank accounts. Okay, so let's go on. So that is this company's assets. So next, we're going to go into, they have fixed assets. So before we move on to assets, they have fixed assets. So their fixed assets is $10,913. So what exactly are fixed assets? So fixed assets are things that it pretty much, fixed assets are purchases for long-term use that are not likely to be converted into cash relatively relatively quickly. And they can include things like building, computers, equipment, furniture, land, machinery, vehicles, cars. It can be, this is for over extended period of time. You're not going to just convert it into cash. So that's pretty much what fixed assets are. So let's go ahead and continue on. So this particular fixed asset, they have 10,914. So the total current assets is 25,692. So this is everything that this company owns right now. So next we're going to go into the liabilities. Liability is debt. It's what you owe. Anytime you hear liability, liability means debt. You owe this money. So we have accounts payable. Accounts payable that means that's bills that you need to pay. Those are invoices that you need to pay other people. That's what accounts payable mean. Accounts receivable is invoices that your clients or your customers have to pay you. Accounts payable is invoices that you're paying to other people. So that's 5665. Line of credit, self-explanatory. It can be store credit, it can be credit cards, etc. They have $792. And then the current maturities of long-term debts. Long-term debts could be like loans. They have 500. So their total current liability is 6,957. And they have long-term debt net of current maturity. We're not going to get into that. That's 5,000. So for the total liability is 11,957,000. So that, like I said, that is debt. So debt subtracts from what you own. So we're going to subtract, you have your assets, we're going to subtract the debt, and then we're going to come down to the equity. So the equity is what's remaining. So underneath equity, we have common stock. We have $15,000, $15, not 15,000. Common stock 15. It just says 15. Additional paid in capital 5,000. So this can be monies that the shareholders paid into the company, and it was $5,000 in addition to what they've already paid. Retained earnings is the next one at 8720, so $8,720. And what exactly is retained earnings? So retained earnings is the amount of profits a company has left over after paying all of its direct costs, indirect or direct costs in income taxes and its dividends to shareholders. So I'm going to say that again because I think I said that kind of, choppy. So retained earnings are the amount of profits that the company have remaining. So that's the net, what you have remaining after all your expenses, after paying all of the costs and expenses in your business, the income taxes, and anything that they have paid out to the dividends or shareholders. That is what's called retained earnings. So that's what's left back. So the total equity, again, is 13,735. So the total liability, including the equity, is 25,692. And if you look up and you see the assets, your total assets is 25,692. So when you subtract your liability and your total equity should equal to the same number as your total assets of 25,692. And when you are doing your books, or your accountant is doing your books, or whomever is doing your books, when you look at your balance sheet, the assets and the equity need to match up. The assets minus the liability and the equity needs to be the same number. If its numbers are different, the books is not balanced and it's off in a particular way. So anytime you run the report, it should always match up. The top has to match with the bottom, or for those more, if you actually went to accounting school, the left has to match up with the right. Okay. So that's pretty much a quick overview on that. So next, we're going to go into the last one, which is where it is. The balance sheet. We did the income statement. We're going to go into the cash flow statement. So let me add that up on screen there and open up my screen so I can see it a little bit better. So the cash flow statement, what exactly is a cash flow statement? Or in other words, it's called the statement of cash flow. Either one of those is the name. It shows the money that's going in and out of your business. It's used for investing and it shows the investing and your financial activity for your business. So this is very important for your business in terms of showing what the money your business actually have. So when you look at that profit and loss sheet, that pretty much tells your business how it did that year, the money that came in, all the expenses that you had, and what's remaining. When you look at the cash flow statement, this is the true report card of your business, because this really tells you how your money is being spent. Are you profitable? Are you in debt? Are you spending too much? You're not spending enough? there is such thing as not spending enough, because if you have a high revenue and you want to continue to scale, you don't need to keep hoarding this money. You have to invest into other things in your business, maybe purchase more inventory, hire more staff, do whatever you need to do so you can start to scale your business. So there is such thing as not if having too much money. So it pretty much tells you the health, the true health of your business. So you may look at your bank account, or you may look at that profit and loss sheet, and it tells you my business have money. But when you look at this cash flow statement, you like, ooh, my business broke. My business don't have as much money as I thought that it had. And we're actually going to go through this to kind of explain some things a little bit. So here we have, so they went on over to 2023 for this particular one, and then they have 24, 25, 26, 27 as they're doing projections on this. So we're going to go with 2020, underneath 2024. They have the net income 3,034. Now this net income, it doesn't line up because I just took random statements from this particular off the web. But when you look at your profit and loss sheet, whatever the net profits shows on that bottom of that sheet, that is the same number that's going to be on the net income here. It's just coming over and showing you a different report. Okay, so they pretty much feed off of each other. So that net income is 3,034 for this particular example. So we're not going to talk about depreciation and amortization on this particular one. That'll be another one, or I'll do a master class on that. So we have changes in working capital. So this is where you can kind of see where they're spending, if it's positive and negative, and what's actually going on in this particular business. So in accounts receivable, remember what I said account receivable were? Accounts receivable are invoices. So this is invoices that you send out for your clients or your customers to pay, and they have not paid it yet. So that's why it's showing negative $797. So this particular company, they got money out there that they didn't collect yet. So they got to send the collection agency. Maybe it's not time to pay it yet because maybe they have a net 30, which is 30 days out, or 60 days out. So it's not due yet, but it's showing here because it hasn't been paid yet. Or it's actually late. The customers was over 30 days, over 60 days, over 90 days. At that point, we're going into collection status. So $797 is what this company has in outstanding invoices that they didn't collect this yet. Inventory, they have $395, and this could be $1,000. This is $797. I'm just saying dollars, but this could be $797,000, $395,000. This could be those numbers, okay? Accounts payable is $499. So account payable, remember what I said what accounts payable were? Accounts payable is money that you owe other people, invoices that you need to pay to other people. So this one is in a positive. So they've actually paid their accounts payable $499 or $499,000, because that number on top, instead of being 334,000, it can be 3 million. Okay. So let's go down. We're not gonna worry about the other things that's going on with the revolving credit and all of that, because they don't actually have any at the moment. Net cash flow, it's $2,340. So this net cash flow, it pretty much reflects, it has the net income is $3,034. If we go back up to the top where it says net income, $3,034 after the subtractions minus the $797 for the invoices that the clients haven't paid yet, $395 for the inventory. That an inventory, I didn't explain that negative inventory, that can be returns. So customers or clients return products, or it can be lost inventory. That's why it could be a negative number there. Okay. So for the inventory and accounts payable, 2,340 was the net. So the cash flow, that it's a pretty much subtract those purchases from the net to give you 2,340. So the beginning cash balance. So at the beginning of the year, when the books was opened up, when they moved from 2022 into 2023, the beginning of the beginning cash balance was $2,000. So this can be for the same thing for 2021, in 2022, and so forth. So whatever amount you end the year with on December 31st, that is the exact amount that you're going to start the year with January 1st. Okay. So whatever you end the year with, and this is important, especially if you have inventory, whatever your inventory amount is on December 31st, it should be the exact same number on January 1st. So beginning cash balance was $2,000. The ending cash balance was $4,340. This is the end of the year, December 31st. Or it could be for whatever period that they pull together. So they could have pulled this particular report for half of the year. So instead of doing the entire year, they did it from January to June or January to July. But we're just going to say December, even though we are November right now. We didn't quite make it to December, but we're just going to pretend this is December. So 4340, that's the ending balance. So if they began the year at 2000 and they end the year at 4340, that means this company is profitable, as reflected in the net that showed they have a net profit of 2,340. That is what was at the end of the profit and loss statement. And it's also on this balance sheet, on this statement, on this cash flow statement, to show you what actually went on in your business. Now, this, like I said, I just pulled this example. So this wasn't the best example that I have. I just didn't want to have to spend all this time going through the internet to find one that matches up service-based per se, because it was kind of difficult to find, three statements together that somewhat coincide with each other. On your particular statement of cash flow, it may look different. It may have more things on there. It may have things listed on there that is not here. Things that are here may be on yours. So it might be different. You may not have inventory on yours. You definitely may have invoicing on there. You may have accounts payables, and you may have receivables on yours. So this is a pretty much in a nutshell of overview on these statements, these income statements. So this is why I said it's very important to, and remove this, we can go back to the regular screen. Very important to have these statements and knowing what they all about for your business, because it's really going to tell, it's a report card for your business. It tells the health of your business, how well you're doing financially in your business. So analyzing key ratios and trends. So beyond just reading these statements, analyzing key financial ratios like profitability, liquidity, and solvency ratios. Also look for trends over time, such as increasing expenses, fluctuation in income, to make informed decisions for your business. So when you're looking at these statements, each statement tells you something different, and it's going to it's going to help you to make decisions in your business. Do I need to start hiring people? Do I need to start cutting down expenses? Is it time to expand? It's time to cut back some expenses because we're spending too much. If you have a product base, or even if you're service based and you have products that you are selling, so you have inventory, do I need to invest in more inventory? Because as I see some of my clients that I have, we look at their inventory, and I know for a fact some of them, the more inventory they purchase, the more money they make. So I'm always encouraging them, buy more inventory, because you're selling them like this, that means your income is going up. Other clients that I may have, they're purchasing all this inventory, but the inventory is not moving. They're not selling it as fast. I'm like, hold up now. We need to cut back on purchasing on inventory and start putting that money into your operations, because underneath those operations, you may need to now start hiring people so you can start outsourcing some things in your business. You're not doing it all by yourself. So it tells different stories. And of course, that cash flow statement, the balance sheet, it tells you something different when it comes to your assets versus your liability, and then of course your equity. So here's a real life scenario. See, imagine a consultant whose income statement shows increasing revenue, but the cash flow statement reveals a negative cash flow, which we do not like to hear or see that. This disparity could indicate issues like delayed client payments or high upfront costs necessary, or pretty much kind of making you have a strategy shift. At this point in time, if this is the case, if you're looking at your statement of cash flow and it reveals a negative cash flow, you want to look at this and pretty much look at what those invoicing. Did the clients make their payments? Because that might definitely be a huge indicator, as we saw on that particular statement that had 797 in unpaid inventory. That could potentially be you, or high upfront costs. So that means you're spending money in the upfront for making purchases. As you can see, this company had a high amounts of inventory. So that's a high upfront cost that they're making this purchase, but then they're not selling it as fast. And then the revenue didn't reflect that inventory. 86%, almost 87% they were spending in inventory, relative to 10% in the profit that they have, because that the inventory was just way too high. So some tips for maintaining accurate statements. So to make sure that you have the most accurate books, you want to have regular updates and review your financial statements. And regular updates, this can be every single month, every single quarter, or every single year. I definitely don't recommend you waiting a whole entire year. A lot can happen in a quarter. Imagine waiting an entire year. So I would say at least every single quarter. If you can get to the habit of looking at it every 2 weeks because you have a team in place, then that's better. If not, at least monthly, the latest quarterly, to sit down every quarter to really go through and review your financial statements. Use reliable accounting software. So if you're doing this by hand, good luck with that, because that's going to be a whole lot of adding, subtraction, and minusing. And the books can go off easily, because sometimes when you're tired, you see one number and it really means something else. And then you can one number can really throw things off for you. So definitely don't recommend at this stage you doing paper and pencil the old-fashioned way. Use some type of software. I know I've mentioned softwares, like I use QuickBooks, there's Wave, there's FreshBooks, there's so many different softwares out there that you can invest in and use, and some are free initially or low cost, but as you scale, it's not about the money, it's about efficiency. So as you scale, you want to upgrade to a little bit more higher tech, and a little bit more that's going to do more, because those basic reports and those basic functions may not serve you in your business when you start moving up into those higher figures. And consult with financial professionals for complex matters. So you might be doing this by yourself initially, but as you continue to grow and scale, you definitely want to put the professionals on staff so that they can take care of this. You can outsource it to somebody outside, or you can hire someone in-house where they're working for you directly to work on and manage these financials. So some key takeaways: understanding your financial statement is non-negotiable for successful businesses and management. They are vital tools for strategic planning, securing funding, and driving growth. So if you want any type of funding in your business, as I was saying, remember when we were looking at one of those, what was we looking at? The cash flow statement. We were looking at the balance sheet, or I don't remember which one we're looking at. And I was saying, and they had the projections on the profit and loss statement. And I was saying that projections is used for funding. So if you want any type of grants, or if you want certain loans, particularly grants, they're going to want to see the financial health of your business and how well your business is doing to determine how much they may potentially give you in those grants. So if you're a startup, especially, or even if you've been in business for a long time, they want to see where you are right now and how is this business is going to go along moving forward. And of course, for investors may want to see those projections also, because they want to know what they're investing in. So that's definitely, these reports is going to be crucial for those things. And of course, for growth, if you want to expand, you want to add new locations, you want to bring in new staff, all those reasons is going to be beneficial to you to have those financial statements. So to start to wrap this up, mastering the art of reading financial statements equips you with the knowledge to make smarter business decisions, stay informed, and stay ahead. So I'm just going to give you a little bit teasers for the next one coming up. So next, we're going to dive into the strategies to manage and improve your business cash flow. So tune in for Cash Flow Mastery, fuel your business growth to unlock critical insights for financial success. So that is going to be on the next one. So don't forget to go and click this link that's going to be, I'm going to have on this side, and it's not going to be on this live. It's going to be about an hour later. If you go back and watch the replay, the live is going to be here. If you can't wait for the live on my YouTube channel, you go click on the playlist, Pathway to Financial Mastery, and that last video where we talked about profit first methodology, that's the one you want to go check into. That's really going to dive into budgeting and really to kind of get you ahead of the game on how to manage your finances. This one was a segue into that. And then next week, we're going to continue on with that cash flow mastery. So thank you for joining me on this financial journey. If you are enjoying these insights, don't forget to like, share, subscribe to the channel. And if you're on Facebook, come on over here on YouTube and subscribe and like. If you're on Facebook, share this content and let others see it. Even if it may not be beneficial to you at this moment, share it, because someone else in your circle, they may find a benefit from this and may need this information. So here's to making informed, prosperous business decisions. And I will see you on the next session. And I hope you guys have a great and wonderful day.